Hey, it's Jim, and this is level 3 of the CFA program, the topic on alternative investments for portfolio management, and the module on hedge fund strategies. Notice this is part 2. I sure hope you just completed watching part 1, and I sure hope you got out your 6 index cards. You should have 3 of them completed with the equity and the event and the relative value hedge fund strategies. Now let's look at your other 3 index cards. You already have placed the words opportunistic, specialist, and multi-manager at the top of those. So let's go ahead and get right into opportunistic hedge fund strategies. And we need to do some comparisons here. Notice there are fundamental-based strategies, which we know about, probably even before you entered the CFA program. We're going to use fundamentals. What does that mean? Economic data from the macro economy. We're going to use information and data from industries or sectors, and then the like from individual companies. So fundamental-based strategies as opposed to technical-based strategies, which is probably going to look at things like historical stock prices or pricing trends. Of course, there's lots and lots of statistical tools available to us. Boy, we spent a lot of time back in level 2 looking at time series, and so that's probably going to help us there for technical based. We can also compare discretionary implementation, which is the use of our own kind of judgment. Well, we need to be careful about behavioral biases when we use this discretion implementation, because remember that even though investors in general have their own set of biases, we as financial analysts, we might have our own sets of behavioral biases. Notice overconfidence is probably primary into that behavioral bias. Compare that using our own judgment to a systematic implementation. We're probably going to use some type of a computer system or an algorithm with very little input from us as humans. We can do all sorts of factor analyses. We can do clustering. We can do all sorts of really, really cool things to try to let the computer decide what is important for us, and then it's up to us to try to figure out how to apply those clusters or all those kinds of things. Remember, we've had conversations about this. And now look at the bottom there. This is probably a good answer to a question. Struggle to adapt to new and complex situations. I'll go ahead and date this particular recording, even though I try not to do that so that they don't seem like they're out of date. But in the relatively recent past, we had the SV Bank, we had that failure, and clearly, whether or not we use discretionary or systematic implementation, maybe looking at California banks that catered to the tech industry and startups, hopefully here, what we could have done is kind of uncovered that this was an overvalued financial institution, and we could have thrown that into our hedge fund strategy as part of, what did we do before? What do we call that? The dedicated short bias. Boy, wouldn't it have been awesome to have Enron and Silicon Valley Bank in that dedicated strategy for us, right? All right, common hedge fund strategies under opportunistic. So this is global macro and managed futures. Let's go ahead and start with the global macro. You can do this among a variety of themes, regions, or styles. So look at some of the examples we have there. Oh boy. Trading undervalued versus overvalued. Now, we've been doing this back in part 1, and here we are in part 2. Now, we've been looking at individual securities, but we can extend that to currencies. So we can use over-the-counter swaps as this kind of a global macro strategy. So you see the idea. You have a swap contract, whether it's an interest rate swap or a currency swap or a volatility swap or a commodity swap, whatever that is, you're kind of taking a global or a macro picture. Now, you can also take a look at different regions, different national indices. So we're going to trade stock index futures contracts. They might trade over here, and they might trade over here, and there might be a difference in valuation, especially for the farther term contracts. And then the style goes back to what we were just saying on that previous slide, systematic versus discretionary. What we can do then is we can look at some type of a futures contract, maybe an energy futures contract, where we have a systematic strategy and we have a discretionary strategy, and there might be a spread somewhere in there, and then we could use futures contracts to take advantage of that spread. Go ahead and get out our index card under Opportunistic Hedge Fund Strategies, Investment Characteristics. This is what we said just on that previous slide. We can use fundamental, technical, we can be discretionary, we can be systematic, and these relatively successful global macro managers probably use a combination of those as well. They can be directional, they can be thematic. Directional just simply means that, of course, we think that the price of orange juice is going to go up. So we go ahead and enter an orange juice futures contract. So that's directional. Thematic, we might say something like, you know what, we think the price of commodities in general are going to go up, which might include orange juice. I have to include orange juice for those of you who love Trading Places and Eddie Murphy and Dan Aykroyd. But there are other commodities out there, sugar and oil and gold. And so we might make a general kind of a commodity futures contract play that would reveal that basic theme. Now, of course, that theme could be directional for some people. Some of those contracts in the theme, probably most of those contracts within the theme. And so even though the reading does tell us a little bit about the difference between these two, there's probably a little bit of overlap. That's all I mentioned that for. How about risk profile? So what are some things here? We've got, 5 diamond points here. So what kind of stuff are you going to write about this on your slide deck? High volatility, that makes sense. Anticipatory, that sounds like a good word to write in there. Sometimes contrarian. Of course it could be contrarian. There's an example about quantitative easing from 2009. Quantitative easing, I don't know. I think we're still in an era of quantitative easing, but maybe I'm the only one that thinks like that. Stability has made it difficult to generate strong returns. I probably wouldn't worry about this too much. But here, I like that last point. You might want to write this on your index card. Central bank's intervention, further dampen volatility and trends. So central banks, they come in and they intervene and they try to do something good. A lot of times they do. Sometimes it has the opposite effect. Returns can be unstable and inconsistent and volatile. Maybe you want to write those 3 words down there. Liquidity, of course, if we're using futures contracts, we've got lots and lots of liquidity in there. Leverage probably depends on the size of the fund. I think we talked about leverage and that in part 1. Why do we use leverage? Of course, magnify returns. That's true for leverage all the time. So let's make sure that if we're using futures contracts, that's probably highly liquid. If we're using just let's say a currency swap between the US dollar and the euro, that's probably highly liquid. But some of these other derivatives may or may not have that kind of liquidity. But the important point is that they all have huge amounts of leverage. And so inside of this opportunistic hedge fund strategy, the manager may use low leverage and may use high leverage, depends on risk tolerance. So the key to answering this question is there's going to be a sentence somewhere in the question stem that says something like, hey, you know what, risk tolerance is super high. And then somewhere down below, there might be a question about what kind of leverage do you think? And then, of course, you would say high amounts of leverage. All right, strategy implementation. This, of course, the name is global macro, so we're going to do top down. Manager who makes directional predictions use fundamental data. A manager who prefers the relative value strategy is probably going to go to market data and take a look at, this particular asset and this particular asset to kind of see which one is over or undervalued. And this swings back just a little bit to what we were talking about back in part 1, where we did the pairs trading. Now, I'm not saying here that we're going to do pairs trading, although there's nothing really that's going to outlaw pairs trading here in opportunistic hedge fund, but that's probably not the main goal or the main strategy function inside of this particular strategy. Correct fundamental view, proper methodology, and timing. So that's characteristics of a successful macro trader in this hedge fund strategy. Now look at that bottom bullet point down there. Boy, timing is everything. I've said this to you guys before. My wife is a big fan of that. Timing is everything in life. And so incorrect implementation, too early or too late. And then layer that with an inappropriate method. I mean, clearly we don't want to use the capital asset pricing model to determine whether an orange juice futures contract is over or undervalued. Why are we doing this? Provide diversification. Generate strong returns. I mean, that's probably the goal in every one of these hedge fund strategies. Some can be more successful than others. What are we worried about? Boy, we're really worried about generating large positive returns than we are worried about large negative ones during a market turmoil. And so that probably lends itself to portfolio diversification. All right, so that was the first opportunistic. So let's do the second one here. Managed futures. We're taking both long and short positions. We can trade individual contracts in futures or swaps, even forward contracts, although forward contracts are kind of dull. Notice down there at the bottom right, we have exotic contracts, futures contracts on weather and derivatives. You might know that there was the possibility of creating a hurricane futures contract. And this is designed, of course, theoretically to help insurance companies manage risk, to help homeowners manage risk. But the practicality and the legality and maybe even the morality of these is that you really can't have a futures contract in which some people are watching the Weather Channel and they're rooting for Category 5 to crash into the shores. That just doesn't sit well with us, as Kramer says on Seinfeld. But nevertheless, there are weather derivatives out there. There are contracts on carbon emissions. And there ought to be contracts, I'm saying this here as an editorial part of this recording, there ought to be derivative contracts on corporate governance and what these board of directors look like. And boy, that would really ensure that the shareholders are getting the board members of a high skill set and a high quality that they deserve. Investment characteristics. I'm going to go back to Harry Markowitz and the efficient frontier. So just picture the efficient frontier. Remember that non-linear locus of points and what we're trying to do with managed portfolios. This is why we're on the efficient frontier from Harry Markowitz, and then we try to push upward and to the left. And those managed futures improved efficient frontier. So what does that mean? It either means more expected return or less risk. That's why we have that second arrow point there, improves the risk-adjusted return profile of traditional portfolios. So think about this in this opportunistic with the managed futures. We're using the managed futures. We're actually layering our portfolio with managed futures. How about leverage? High degree of leverage. What does that say up in the top? Majority of capital invested in short-term government debt, and probably a little bit of that is used for collateral for the long and short futures contracts. Liquidity, high liquidity. I mentioned that a couple of times before. Strategy, implementation. A lot of different ways to do this. Skip down to the fourth arrow point there. Incorporate fundamental relationships, fundamental factors. This is what I try to teach my students about futures contracts the simple fact that, of course, we take the long position, we're betting that prices go up. We take the short position, we're betting that prices go down. But we can layer that kind of an analysis with factor models that are unique to each individual futures contract to try to push that efficient frontier up and to the left. Skip up to the second arrow point, pattern recognition. So, of course, we might make a play on momentum. We might make a play on volatility. And we might make other plays, right? There might be something about the orange juice futures market that might not fit into the traditional momentum or trend or volatility, but maybe it's something on the supply side, maybe it's something on the demand side, or maybe it's just the simple fact that Eddie Murphy says that the price of orange juice is going to fall because he has looked at the true crop report. So remember, there's a combination of those fundamental factor models that can be applied all over managed futures. All right, so what do those boxes tell us down there at the bottom? Of course, time horizon. There's always, there's carry relationships that's discussed up in that, the fourth arrow point. Do we want the near-term contract? Do we want the far-term contract? Do we want to roll them over? How do we roll them over? Of course, the rolling over is going to be determined by our confidence in momentum, or our confidence that, look in that purple box, that there's going to be a momentum reversal, or if we've executed some kind of a trailing stop loss, we might have a price target. You think about all these different things. Just go back to the Eddie Murphy orange juice futures contract, and you're going to combine all of these things. You can combine all of these things to, let me just go back here. Where am I here? To improve the risk-adjusted return profile. That makes perfect sense, right? All right, how are we implementing this? I just said time series momentum, so this is the most popular. Time series, we're just taking a look at the historical prices, and we're going to try to find patterns and trends and momentum and reversion to the mean and any of those other things that we've talked about in the CFA program to try to implement that strategy to say, yeah, it's time to go long or it's time to go short. Of course, what we can do is cross-sectionally evaluate the momentum where we took a position in lots of different assets. So, this is what I was saying earlier about we have the orange juice futures contract, we have the gold futures, we have the oil futures, we have the lumber futures. We take a cross-section. Cross-section means, different firms, or in this case, different underlying assets. And we're going to try to determine whether or not this, maybe we'll do some cross-sectional regression analysis. Maybe we'll throw a factor analysis in there. And maybe we can identify subsets inside of there that will warrant long or short positions. Diversification benefits, of course, that makes perfect sense. But look at that third bullet point there. May experience larger gains during periods of market turmoil. May, but the penalty of that is that there might be some extra skewness in there. So remember, in all of our conversations, especially going back to Harry Markowitz, we're just assuming first and second moments of the distribution characterize the distribution. We assume skewness is zero. We assume kurtosis is zero as well. But this is probably a really cool exam question. If we have periods of market turmoil, hey, we may win out, but we might have to pay the consequence of skewness in there. Probably going to be negative skewness, but it could be positive. All right, how about our fifth one here? Specialist strategies. Niche markets, deep understanding of specific market characteristics and dynamics. Look at that second arrow point. This is something that I would write down on my little index card. Generate returns that are not correlated to traditional assets. So this is how, in the specialist strategy, where we're going to improve the risk and return trade-off of the traditional Harry Markowitz. Volatility trading, reinsurance, and life insurance settlement. So let's go ahead and start with volatility. Ever since the Black-Scholes-Merton option pricing model was published back, a long time ago, 1970, let's say, that there's been this fascination, and fully warranted, I mind you, that we can use that model to come up with some measure of implied volatility. And this is super important. Of course, with derivative securities, which we're talking about inside of the hedge funds, this probably means that there's going to be the use of the Black-Scholes-Merton option pricing model to give us an estimate of volatility. And so volatility trading since then has become super popular, and it's its own investable asset. So I tell my students the following. I say, look, if you think that volatility is going to go from here to here, well, that's the natural lessening of volatility. That's the short position. If you think volatility is going to go from here to here, well, that's the long position. But what's cool about this volatility trading inside of these hedge fund strategies is that you can compare the volatility of, let's say, orange juice with the volatility. Let's suppose there was a grapefruit futures contract. So you would think that these two underlying assets would probably have similar volatilities. I'm making that up, but it sounds like they ought to have it, right? They are both grown in Florida. They both taste good. We eat lots of those things. And so relative volatility strategy is one in which these two standard deviations of these two contracts, they kind of move away from each other. And so we're going to, purchase underpriced volatility and sell overpriced volatility. That might not be a bad idea for you to think about the answer to this question if you visualize grapefruit and orange on the exam. All right, how about the risk profile here? Time zone arbitrage. Here's once again that term. I explained this back in part 1. I'll go ahead and do it fairly quickly here. This is arbitrage in the sense that we are narrowing our possible outcomes, hopefully with more outcomes that are positive than are negative, but it doesn't mean that we're not requiring any investment, we're not taking any risk, and yet we're still yielding a positive return. That's the classic definition of arbitrage. So here, all we're doing is we're going to take a look at derivatives that are traded in different time zones. Of course, there are time zones. We have 4 here in the United States. Boy, how many time zones are there in the world? I don't have any idea. Boy, do I have a confused look on my face? Boy, if I was smart, I would have looked that up before I started this recording, but I have no idea what it is. I'm guessing that you guys have found this out already, punching away on your computer. Nevertheless, there's a time zone over there, and there's a time zone over here, and there are contracts that are traded on those two exchanges inside of those time zones that might have different kinds of not just prices or yields, but in this case, since we're talking about a specialist strategy, volatility. Yeah, look at that second one. Options on the Australian dollar consistently trade at lower volatility levels within Asian time zones. I really don't know what that means. That sounds to me like this is a true violation of the Eugene Fama efficient markets hypothesis. But nevertheless, things like this do exist, and there are probably some really good efficiency related reasons. Maybe there are different tax treatments in the two countries. Maybe there are different margin requirements on the two different exchanges. Maybe. So we could come up with probably some good reasons there. However, they still may provide an arbitrage opportunity. There's cross-asset volatility. That's what I was saying about the orange juice and the grapefruit. This is what I love. Look at the purple here. Outright long volatility trading. What we need to do here is, once again, use our favorite Black-Scholes-Merton option pricing model so we know the delta of that option. And you can use that and apply it to futures contracts or swap contracts. And then you need to manage gamma exposure. So I would write that down on my, my index card. That's probably a really, really good answer to a question. Look at the bottom. Volatility tends to revert to its mean over time. I try to emphasize that in all of my recordings. When it's relevant, please don't forget reversion to the mean. Here we go. I like that first bullet point up there. More consistent returns in normal market conditions. Now, this is the second time we've said this on one of our slides here. I want to call your attention to some of those problems at the end of this module. Somewhere in the question stem, there'll be, hey, normal market conditions, there'll be surging market conditions, and there'll be crashing market conditions. So those are going to be key terms that you read inside of the question stem. So remember this: normal market conditions, which normal market conditions exist most of the time, right? More consistent returns, long position in volatility, which has positive convexity. Oh my gosh, how cool is that? And that positive convexity can then be used as a hedge. Liquidity, I'll just go ahead and repeat myself again. It really depends on what the exchange is and what is the contract. If we're looking at an orange juice futures contract, then that's probably had lots and lots of volatility because it's traded on an organized exchange. If it's a grapefruit futures contract and it's traded on Jim's over-the-counter exchange, I just made that up, then it's probably not too liquid. That's why that last bullet point there, over-the-counter contracts tend to be less liquid. Leverage, of course, because when you enter a futures contract or a swap contract, you don't have to pay anything, right? You have to put up a margin, but it's still your money, so you get to pick how much leverage you want, right? And you remember back in level 2, we had a conversation on somebody who was hedging, and one of the questions was solve for the number of futures contracts. Well, that's the application here of leverage. Strategy implementation. Of course, we can use exchange rate options. We can use over-the-counter options. We can use futures contracts, and we can use swap contracts on volatility or variance swap. Remember the difference between the volatility swap and the variance swap? You probably remember that back from level 2. Now, how about insurance contracts, reinsurance, and life settlements? Yeah, so hedge funds have been, as part of this specialist hedge fund strategy, they've entered the insurance and the reinsurance market. Here's just a quick gray box to tell us that insurance has been around for a really, really long time. There's me over there. I'm the purple dude. There's the life insurance company. What you miss in there is my family members who say, hey, you know what, Dad, are you sure you're worth more alive than you are to us with your insurance policy? And we get a chuckle out of that. And I'm sure lots of families do the same kind of thing. Now, this is what we're talking about here. There's a secondary insurance market, which, in the old days, and when I say old days, I'm just talking about decades ago, that it probably was less liquid. But the liquidity has probably improved, especially, in the last 10 years or so. Look at that second teardrop point, grown significantly in recent decades. And so this happens because some individuals, I'll just take myself as an example. Let's suppose that I have $1 million life insurance policy on myself, and then I come up with a product. Here, I'll pick it up. Here's this product, and I sell this product out there, and all of a sudden I sell 1 trillion of them, and I'm a billionaire. Well, what do I need that $1 million life insurance contract? So, I could donate it to a charity, or I could sell it. And so this is what's happening here: secondary insurance market. Excuse me. Now, of course, what happens here is that I probably am not going to think about this too often, and my insurance company, they're probably not going to think about it too often. And that's why we have these third-party brokers. And so what they're going to do is they're just going to go in, jump in, and say, you know what, Jim, you probably don't need this. How about if I buy it, and then I'll sell it to a hedge fund. Now, of course, there's life insurance and there's catastrophic risk insurance to prevent against all sorts of disasters out there, not least of which are earthquakes and floods and hurricanes, but against kind of any kind of these disasters. Some of them could be man-made, some of them could not. I'm guessing that there is some kind of a reinsurance out there that somebody has bought because they're worried that an asteroid is going to crash into Earth. I'm not sure how much you'd be willing to pay for that kind of a thing, but yeah. All right. What do we like about this? Sufficient diversification, uncorrelated geographic diversity. This reinsurance thing really goes back to the basis of the mortgage-backed security movement when banks, here I'll just say in the United States, banks that had mortgages in the western part of the country could package these things and sell them to somebody who lives in the eastern part of the United States. So you have geographic diversity. That's pretty fun. We've purpleized this one. Is that a word? Hedge funds add alpha to their portfolio while also adding diversification. Yeah, this is what I was saying earlier. Investments are typically illiquid, but they have become more and more liquid as time goes by. They're probably not too easily transferable. However, that market is expanding. And so, you get this sense that the hedge fund manager is probably going to work really, really hard. What do we call that? Due diligence, to make sure that he or she wants to hold on to that contract, for the life of that contract, so that there's really not a need to sell it. Strategy implementation, we just said that, third-party brokers. So what are we doing here? If we're a hedge fund manager, policyholders willing to sell at a relatively low price. So that's me, right? Premiums are affordable, and there is the probability of the policy being paid out, and that's relatively high. So there's the lump sum, transfer ownership, and there's a little diagram down at the bottom. Yeah, look at that bottom right down there. The hedge fund then receives the future death benefit. So when I go, right, I'm 61 years old. What did I say? I have a $1 million policy. So I sell this because my family doesn't need it. And what's the hedge fund rooting for? The hedge fund is, boy, do they want to make those premiums? They're really not rooting for me to live till I'm 120. But then again, they're not rooting for me to live until just next week, right? So they want to pay the premiums, but they don't want to pay them for a long time. Now, it depends on whether that policy, of course, and I don't think the Institute would get into this, what type of a whole life policy this is. Is it variable? There's standardization going on in this market. I can't imagine the Institute would ask you those kinds of questions, though. So present value of that future death benefit is greater than the present value of the premiums paid. That makes perfect sense. So here's kind of this a flow chart of what I was saying earlier and what that earlier slide says. We're going to do the analysis. Expected cash flows, right, versus mortality, time to mortality. What does Jim's health look like? I walk almost every day. I try to eat right, but who knows? Who knows what's going to happen? Both of my parents died of cancer, so who knows? So the hedge fund is taking that risk as opposed to the insurance company taking that risk. Let's go ahead and take a look at an example. And it's a little bit more complicated than what I just described about me and the insurance company and the third party. The reality of life is that these third parties, what they do is they approach the insurance companies and they say something like, hey, you got any of those assets that you want to sell? So they'll buy them and then they'll reach out to a bunch of hedge fund managers and say, hey, I have all of these life insurance policies or catastrophic insurance policies. Are you interested in buying any of them, or are you interested in buying a pool? And so that's what this example really tells us. So the hedge fund manager is really not going to look at me like individually, like I was suggesting in that earlier example, but the characteristics of the pool of insured inside of that policy. The interesting thing about this from the catastrophic perspective is that, you don't want to buy 100 policies that are in one particular area. You want to buy them as spread out geographically. So let's work through this example here. Here we are, firm, working relationship with a broker, procuring policies from the insurance company Newstar, offered at a discounted value as they are typically held by policyholders who possess a lower life expectancy. That makes sense. Thorough evaluation of the data and biometric information of the policyholders. That makes sense there, right? Based on this analysis, the team will make a decision on whether to proceed with a bid. So discuss methodology and consideration. So this is a really good essay type question. So what are we going to do? Forecast the expected cash flows of the investment. Make sure that we have the correct risk-adjusted discount rate. We need to figure out what those ongoing premiums are going to be and the timing of those future benefits payments, what those payments were going to be and what's the expected timing. So you have to be an actuary to try to figure out who in that pool of funds is insured is going to die, who's going to die sooner, who's going to die later. So there we go. We calculate the present value of all of those cash flows, both positive and negative. And then if that present value is greater than the minimum price, well, then it's going to have a positive net present value. And you learned this back in level 1, of course. Now, notice that last bullet point. This is what I was saying just a moment ago. High competition in the bidding process. Wow, we may have to adjust our bid to improve our chances of winning the bid. But then, of course, there's that winner's curse if you actually win the bid. All right, how about our last index card, multi-manager hedge funds? All right, so what does this mean? Exactly what the name suggests. What we're not doing is investing in one particular hedge fund strategy, but a diverse set of strategies so we can create our own mix. We can use a fund of funds or we can use multi-strategy of funds. So let's go ahead and start with a fund of funds. So what we're going to do as the hedge fund manager, pool the investor's capital and allocate it to a whole different set of hedge funds. So we could use those previous 5 strategies. They're probably going to be less correlated, right? We want to take advantage of diversification. So what is the role of this fund of fund manager? Yeah, ensure diversification, lots and lots of hard work, due diligence, strategic allocation, not to mention tactical allocation, but also include style allocation in there. Boy, we'll have to worry about risk management. That makes sense. What this does, it provides investors with access to some funds that are closed, economies of scale, currency hedging, liquidity efficiencies, research expertise. So what do you want to write down on your index card? Probably not all of those. Pick a couple that you think are important. I would say that ensure diversification is a good one. If I were creating this question, I would clearly go for the economies of scale. Disadvantage, oh yeah, you're going to pay the fee for the fund of funds manager, then you're going to pay the fee to the regular old hedge fund manager. And because there's this duality, there's probably a lack of transparency. You might not be able to figure out all of those performance fees that we've talked about before. And so there's an issue there. Principal agent issues, we talked about that many, many times. So investment characteristics. I don't think you're going to see anything that's new here from what we've discussed in level 1 and in level 2. There are management fees and then there are incentive fees, but there's probably some extra fees associated with these fund of funds. There's some netting risk, initial lockup period of 1 year. Yeah, that's stuff we probably know. Gain exposure to a broad portfolio of hedge funds. That's why I was saying back here, where was I here? What did I say? I like the economies of scale. I also like the diversification. And, so that's what, whoops, I went too far. Broad portfolio of hedge funds. Better liquidity terms, increased transparencies, lower fees. I guess those are all good things to remember. Strategy, implementation. How are we doing this? Notice in that first point there, a complex process. So we have to do lots of research, appropriate strategic allocation. And so the Harry Markowitz model may not provide us with the beginning. It might not even provide us with any possibility. So we're going to have to come up with our own strategic asset allocation model. A formal manager selection, of course. I could just say, hey, I'm Jim. I'm a multi-manager. Send me your money and I'm going to do a bunch of stuff with it over there. Well, you'd have to evaluate me, right? Formal manager selection process. And you might pick me and you might pick Jenny over there and you might pick Johnny over there. Interview the candidates, right? Risk reports, evaluate, negotiate, and then ongoing monitoring. Let me go back here. From 1 to 9, these are pretty much common steps that the Institute shows and reveals and asks us to know throughout the entire CFA program. Yeah, how about multiple hedge funds with similar structures? So these are sub-funds within the multi-strategy hedge funds, probably managed by the same organization. But look at the bottom there. This is what we're trying to do, diversify. What are these investment characteristics? So what this does is this allows us to make tactical allocations a little bit more easily. Remember, the strategic allocations, that's a huge challenge here for us in this multi-manager hedge fund universe. But then the tactical allocations are probably going to be just a little bit easier under this scenario. Fee structure more attractive. I would write that one down. Tilted toward performance. You could probably know that on the exam. But look at what we have bolded in red. This could increase the operational issues or failures or operational risks associated with our entire investment. Remember, operational risk is defined as pretty much the failure of people, processes, or systems. So whatever that means for this multi-manager hedge fund strategy, that's what we're talking about here under operational processes. Strategy implementation, there's the strategic, there's the tactical. This is just a little bit of a summary of what I've been describing. Look at the green embedded bullet point down there. The fund manager has a direct view of the underlying investments and then their correlations between and among. Remember how I always tell you about when we look at a corporation and we're trying to evaluate their different business segments. A lot of times I call these silos, and we need to worry about the correlations between and among the silos. And so multi-strategy funds, we need to have that same kind of concern. Notice what pops up again, economies of scale. So that's probably important. Well, there you go. There are your 6 index cards. What I would do right now, well, not right now, but I would align them and take a picture of them. You may have to do front and back if you've overlapped, but you have that on your phone and you can study that. Hopefully that allows you to wrap your arms. I've done this several times, right, in part 1 and part 2. Wrap your arms around this massive amount of information inside of this module. All right, so let's move on to the last couple of LOSs. Describe factor models. Oh my gosh, we've done factor models. So how are we going to use these factor models as part of our hedge fund strategy? And maybe even more important, look at the LOS. Understand hedge fund risk exposures. So remember, these factor models, they're going to say something like, hey, do you want to be exposed to inflation or do you not want to be exposed to inflation? Well, if you want exposure to inflation, then invest in these companies. If you don't want it, then invest in these companies. Well, that same factor model can be used inside of the hedge fund universe, not just for long and short positions on individual shares of stock, but they can be used across all of the derivative securities that we've been talking about inside of this recording. So there's a good summary table. I get my phone out and take a picture of this risk exposure. So this takes us through what we've done so far. Long, short, event driven, arbitrage, opportunistic, and relative value. There are risk exposures. That row of risk exposures, boy, these are really, really great exam questions. Now what we're going to do is we're going to use this conditional linear factor model to measure and evaluate that risk. And it's going to look like this. So look up at the top. Here's the return on hedge fund I. And there's an intercept in there. And notice there are some B sub I comma 1s. So those are the sensitivities to each factor. And this is what we've been doing from, oh boy, we didn't do much of this in level 1. But we did a lot of it in level 2. That's similar to what we've done before. But then notice we're adding a D for factor 1 and 2 and 3, whether it's inflation or yield or energy prices or size or momentum, whatever those factors are. And notice that D, look down, that's the incremental risk exposure during market crisis periods. So what's this LOS say? Describe how factor models may be used to understand hedge fund risk exposure. And so what the reading is asking us to understand is, all right, we want to worry about things like in surging markets, we want to worry about things like in normal markets, and we want to worry about in times of crisis. So this factor model is going to illustrate to us and give us a better understanding during the market crisis. Remember that. In fact, you might want to write that on one of your index cards. Yeah. Now, of course, look at the purple arrow point. This model does not entirely determine. Of course, it doesn't entirely determine. There's other stuff out there, but the remaining portion can be attributed to the manager's alpha. That makes perfect sense. And then randomness, that's that error term after the last plus sign there, random errors. Remember that in my academic world, a lot of times we call that noise, and the noise up here cancels out the noise down here. At least we expect them to cancel out. And then there's the big one in red over there, the omitted factors. So remember, we can have factor 1, 2, 3, 4, 5. We can have factors all the way up to 100, but that's going to cost us a lot of money. And then how are we going to manage those 100 factors? So remember, we try to squeeze this down to the appropriate number of factors, but clearly we're going to omit something. That should make perfect sense. Now, there was a model that goes back to an article back in 2007, and here are 6 factors, right? So remember, we're doing this hedge fund risk exposure, so I would memorize these things. Maybe you'll need to take a picture of this with your phone, but you could probably memorize these without taking the picture. Equity, interest rate risk, currency risk, commodity, credit risk, and volatility risk. You shouldn't be surprised that these 6 factors show up in this 2007 model, because I believe I've mentioned all 6 of these during some parts of 2 or parts of 1. All right, how can we use these factor models? Well, we can use this stepwise regression. Remember what stepwise mean? It's the name exactly what it says, stepwise. And so you run some regressions, and then you make a decision, and then you run some more regressions until you get up to something that you like. We try to avoid including highly correlated risk factors because of the multi-collinearity. That makes sense all the way back from level 1. But this 2007 model, a stepwise regression, the bond and the commodity risk back here, they had lots and lots of high correlations, so they were dropped. So this is probably an important, I always question whether or not the Institute would be interested in referring to a specific model and specific results. Clearly, historically, they kind of shy away from that, but maybe they're moving to this. So I would remember these 6 factors, and then I would remember that the bond market and the commodity markets have lots of collinearity. So the remaining 4 factors were used to measure that exposure. So let's take a look at a quick example here. Officer of a pension fund increase its investment in hedge funds, long, short, conditional linear factor model. Describe how he can use this conditional factor risk model to address the concerns. All right, so here's the solution. During normal times, during periods of crisis, whoops, sorry, I didn't mean to do that. During normal times, market is stable. What's going to happen? We'll probably have a benefit of our long returns, our long positions. But what about periods of crisis? Equities fall sharply. And so this conditional model is going to capture those equity securities that are going to fall in price buy greater amounts during that time of crisis. And so then we can use this model to either A, avoid investing in those particular assets or short them. Now, this is an interesting part of this module. The question really asks, and it goes back to the LOS that we've been talking about here, in a traditional investment portfolio. So what do we know? 60% equity, 40% debt. But what if we add 20% allocation of a hedge fund strategy, any one of the hedge fund strategies that we have been talking about? Well, the 60-40 strategy ends up into a 48% stocks, 32% bonds, and 20% hedge funds. I would memorize the 48 and 32, although, it probably show up in the question stem. But an even better question is, what happens if we add 20% allocation? Well, this is super important. Total standard deviation decreases. Total portfolio standard deviation decreases. What that must mean then is the Sharpe ratio increases. What that must mean then is the Sortino ratio increases. Let me just remind you that the Sortino ratio we're dividing by the downside risk. Remember the downside part of the standard deviation. And then that maximum drawdown that we talked about at length in level 2, that probably is going to decrease by a substantial amount. So increased risk-adjusted returns and diversification if we add 20% to our traditional 60-40 portfolio. Here's just a summary of what I just said, right? Sharpe, standard deviation. Sortino, there's the downside deviation there. That makes perfect sense. High Sharpe ratios, high Sortino ratios, comparatively higher Sharpe and Sortino ratios, Sharpe and Sortino ratios not significantly enhanced. So get your phone out and take a picture of this. This is clearly what I was saying earlier about things like, hey, do we have expanding economies? Do we have crashing economies? What kind of factors are important? What kind of those 6 hedge fund strategies are we going to pursue? And so, boy, look at these 4 boxes. These are great, extremely great exam questions. So think about this. Event-driven, they'll probably result in high Sharpe ratios, right? Systematic futures, high Sortino ratios. Global macro, comparatively higher, right? Multi-strategy, not significantly advanced. I would take that picture and memorize that thing there. All right, let's go ahead and talk a little bit more about standard deviation, right? That's our measure of total risk. So go ahead and look at these things. Boy, do you want to take a picture of this? I'm asking you to take lots of pictures, but I think it's going to pay off as you study in those last weeks. When you scroll through your phone and you'll say, okay, smallest standard deviation for the combined portfolio. Well, you have those right there. Boy, is there an explanation? I'm not sure that the Institute would ask you for that explanation, but the explanation is that we're trying to push up on Harry Markowitz's efficient frontier. Small positive impact on decreasing standard deviation. Well, there's the event-driven and relative value, and there's some good reasons down there as well. How about if we use the half standard deviation, the drawdown here? What we're doing is we're going up, and then we're drawing down, then we're going up, and then we're doing that maximum drawdown. So look at that second bullet point there, the largest decline in value to a subsequent low point. So what does that help us do? Well, what we're doing here is we're taking some of these opportunistic strategies, right? And we're going to, kind of overlap them. That kind of looks like a cool thing here. So conditional risk model can demonstrate that these strategies have low exposure or maybe very low equity or credit risk. They probably have good liquidity as well. High max drawdown, there we go. Long short, event driven or distressed. There's a surprise down there. This shouldn't be a surprise. There's a nice picture over there. Conditional risk models show that these strategies highly prone to equity and credit risk during market crises. And this goes back to what I was saying earlier about, the Institute and these questions that you'll see at the end of the module. They want you to know what happens to these strategies during times of crisis. So there we go. we did part 1, we did part 2. You have your 6 index cards. Now I'm going to give you a homework assignment. I want you to go to the module. I want you to spend, I'm going to say 30, 45 minutes going through those questions. And you know what? I give advice before. I'm not sure if I've done it in a while, but go ahead and take a look at the questions and then try to work through the answers. A lot of them are multiple choice, but don't kill yourself. Don't stress yourself out. Go ahead and look at the solution. I think that's an okay thing. Try to answer the question yourself and then go and look at the solution, and then that'll help you understand. And then you'll look at your index cards and you'll say, hey, you know what? This makes perfect sense. So I hope that, what have we spent? Has this been 2 hours now for part 1 and part 2? That's a long time, but hopefully you've gotten your arms around this huge amount of information so that you can answer these really, really cool questions on the exam. So thanks for watching. Thanks for having patience with me during these long recordings. Have a great day and good luck studying.